Some may say boomers did destroy the real estate opportunity for the next generations, and this may be true in many instances, but it was not by design. It was just the economic conditions for that period. Middle-class boomers made money in real estate, but you know what? Boomers felt sold out as well when we expected to make millions starting a trade, taking over the family-owned business, or even taking over the farm was the way to go. These actually became slave jobs with very little opportunity for us, so we know how you feel. Look, I need to level with you about something that most people in my generation still don't want to admit. The real estate game that made us wealthy isn't coming back, not because of some market correction or temporary downturn, but because the fundamental economics have permanently shifted. As said, in my youth, a trade job and business could make you rich. Then economics changed. They were not coming back either. Boomers had to adjust. Now so do you. The irony today is that the trade millionaires are coming back because everyone that should be building stuff is taking gender studies at university. Maybe your grandkids will make money in real estate, but real estate math does not work today. When I bought that condo in 1984, the conditions were perfect for real estate wealth building. Interest rates were coming down from their peak. Housing supply was expanding. Salaries were growing faster than housing costs in most markets. The baby boom generation was hitting their prime earning years and competing for homes. More importantly, the cost of a house was low compared to salaries. It was a perfect storm in a good way. Today, every single one of those factors has reversed or stalled. Property appreciation in major North American markets has fundamentally changed since 2008. Real estate shifted from being a wealth creation vehicle to a wealth storage vehicle, and that is a massive difference. Today, you're looking at 2 to 3% appreciation in most stable markets, mortgage rates that fluctuate wildly, and wage growth that's been stagnant for decades. Property taxes, insurance, and maintenance costs have all skyrocketed. Do the actual math, and real estate barely beats inflation once you factor in all the costs. And rental properties, the game's over there too. Lease rates have fallen back a decade while operating costs have climbed. Everyone's working from home now, so commercial real estate is struggling. Without that appreciation tailwind, you're just a part-time property manager making mediocre returns for a lot of headaches. Further, if some markets do experience profit, expect the government to come in with higher taxes, new taxes, fees, permits, and other revenue models to manage your returns. This is what has happened in every market in Canada for the last 20 years. Do the actual math, and real estate barely beats inflation once you factor in all the costs. And rental properties, the game's over there too. Lease rates have fallen back a decade while operating costs have climbed. Everyone's working from home now, so commercial real estate is struggling. Without that appreciation tailwind, you're just a part-time property manager making mediocre returns for a lot of headaches. Further, if some markets do experience profit, expect the government to come in with higher taxes, new taxes, fees, permits, and other revenue models to manage your returns. This is what has happened in every market in Canada for the last 20 years. But here's the bigger problem that should terrify any financial advisor worth their salt. Putting your wealth in your home is the exact opposite of portfolio diversification. Think about it. If you buy a $800,000 home with a $160,000 down payment, you may have just put 80–90% of your net worth into a single asset, in a single location, in a single asset class. Every financial principle screams that this is insane. You wouldn't put your entire retirement savings into one stock, would you? Yet that's exactly what homeownership forces you to do in today's market. Your home's value is tied to your local economy, your neighborhood school ratings, the decisions of your city council, whether a factory closes or opens nearby, local crime rates, factors completely outside your control. You're not diversified, you're concentrated, and concentration is the enemy of long-term wealth preservation. Worse, your home ties you to a specific location right when the job market demands maximum mobility. Career opportunities are global now. The best job offer might be across the country or even remote from another country. But if you own a home, selling it means transaction costs of 8 to 10% between realtor fees, legal costs, and moving expenses. That's a massive anchor weighing down your career flexibility. So if real estate is out and the stock market is just okay after taxes and fees, what's the play? The answer is building a diversified wealth strategy that gives you both security and flexibility, and that starts with tax-advantaged guaranteed vehicles. Investment insurance is what real estate used to be, a set-it-and-forget-it wealth builder that grows tax-free with guarantees. You're not gambling on appreciation. You're not hoping your neighborhood stays nice. You're building wealth that compounds without market risk, without property taxes, without maintenance emergencies, and without tying you to one location. Here's how it works in practice. Instead of putting $4,000, $6,000 monthly into a mortgage, you put that into an investment insurance plan. It grows tax-free. It's guaranteed. And critically, a few years down the road, you can borrow against it without triggering taxes or penalties, whether that's to start a business, invest in an opportunity, or yes, even buy a home if you decide that makes sense. But here's the key difference. Your wealth isn't trapped in one asset. You maintain liquidity, flexibility, and diversification while building guaranteed retirement income. When you're 50 or 60, you'll have options, not just equity in a house that you have to sell and downsize to access. And this brings me to the real advantage you have over my generation: freedom. Many boomers spent 30 years tied to one city because of their real estate, including their house. Career opportunities were limited to their local area, as many had rental properties. When the industry changed and opportunities relocated, we couldn't just pick up and move to where the opportunities were. Wealth was literally cemented into one piece or a few properties in one local area. Now in 2026, I can do everything in my profession from anywhere in the world. You don't have to make that mistake of locking yourself down. With your wealth in portable diversified vehicles, investment insurance, index funds, digital assets, you can live in Toronto while consulting for a Silicon Valley firm, spend winters in Mexico City while running your e-commerce business, or relocate to Austin if the next big opportunity emerges there. Your wealth moves with you. Your retirement security isn't dependent on your local real estate market holding its value anymore. Investment insurance designed for you is the way of freedom. Contact a SaferWealth advisor to learn how. Watch more videos, work the calculator, prove to yourself. SaferWealth.com. You only have one future,